All right. Welcome, everyone, to a special edition of TradeView Live. I'm your co-host, Ben Tracy. I lead strategic business development at Vision, joined here by my fellow host, Kyle, our CEO and co-founder. And we have a return guest. I think TradeView Live's first repeat guest, Santosh Sankar of Dynamo Ventures. Santosh, welcome back.
Happy to be here, and very happy to be, I guess, perhaps your first repeat guest.
Yes, and for a good reason, because the last time you were here was, I think, the last 1 or 2 weeks of 2025, and we were looking out into 2026, and a week later, the U.S. went into Venezuela. Right? But yeah, we've been talking about that episode as if you're like this oracle, because so many of the things we talked about have happened, and yet so many other things have also happened as well. So we'll take a deep dive into that in just a little bit. But I guess before we dive into that, for anyone newer to TradeView Live or joining us for the first time, why don't we go through our disclosures, Kyle? What is TradeView? What are we here to talk about?
Industry-leading trade intelligence platform from Vision. So we're able to see 57% of all the global ocean freight bookings and movements worldwide, 3 times more than any other platform. We've profiled all the companies involved with that freight, created 90-day trade forecasts as well. And that allowed us to also map supplier and product networks. Plus, we baked an AI researcher directly on top of this. So you don't always have to be a data scientist to get the most out of this. You can just ask questions and get answers now.
And there's a lot of data that we cite during TradeView Live and that powers the TradeView platform. Where does all this data come from?
Yeah, we've spent more than 6 years building proprietary connections to 270 different data sources, whether that's carriers of all modes, over the water, over the land, bring in customs data from different countries, building partnerships with TMSs and booking platforms, licensing data like AIS, et cetera. We make sense of the fragmented information space around containerized freight and turn it into data to then deliver insights and answers.
And since not only this episode, but many of our TradeView Live sessions have talked about leading indicators, what is to come, where do we get that ability to look at these future indicators or really forecast for future insights?
The way we're able to forecast the future with such immense accuracy is one of the types of data sources we receive is the bookings and the booking requests even for ocean freight. And so that allows us to understand what is planned to happen over the next 90 some odd days. And that is with 57% global coverage, that's a very healthy sample size to figure out what 100% looks like. So we've been able to forecast with great detail and accuracy and precision.
Wonderful. So speaking of that, before we dive into sort of a reflection on Santosh, everything that we talked about at the end of last year, why don't we do a quick recap on what's happened in just the last few months and this year. Global bookings, U.S. import, and specifically the China-to-U.S. trade relationship has been a main topic of the focus for TradeView Live episodes over the last year. And we haven't actually visited these statistics in recent episodes. We had some customers say, hey, where's that initial statistic that you typically lead your sessions with? So Kyle, why don't you give us a recap? What's happened in the past 6 months of this year?
Yeah, so certainly global bookings are up just over 6%. We've had quite the surge over the last few weeks, an early peak season, potentially a little bit of fear loading with uncertainty around Middle East, et cetera. And then U.S. import bookings, as expected, not quite as high as they've been in the past, as we've seen the general reshuffling of the flow of goods and commodities around the world since the tariffs have curbed much of the interest to send goods to the United States, and then especially seeing that in China-to-U.S. bookings down 10% year over year. So that shift in sources has definitely played out. We'll look at some slides later with some of Santosh's predictions talking about Southeast Asia to the United States as a bit of a bellwether and example of that change. But generally speaking, early peak season, Worldwide, U.S. imports relatively flat year over year, and China-U.S. bookings are still down as anticipated.
And actually, Santosh, I'm curious if you have a comment about this, because when the Supreme Court really invalidated the majority of the tariffs that were in place, earlier this year, and the refund process started to gain clarity, the Red Sea crisis wasn't quite as volatile and unpredictable as it had been in years past. We expected to see a surge in U.S. import bookings. We potentially even expected to see a resumption to normal activity in imports from China to the U.S. And so far, the numbers don't really show that. Is that a surprise to you?
A bit, but perhaps part of my second half predictions, or I guess kind of things I am monitoring, we can jump into that a little bit. But it is somewhat, I guess, surprising. But I think it was FedEx and maybe even DHL has said that really they're going to be ready to disperse refunds at the end of summer. I think August is what I believe FedEx has been publicly saying on their website. So it might be there's still a lag. You had the Supreme Court pass their judgment, clarity around process, and actually the logistics service providers themselves need to reconstitute and ensure they have their operations in order before they can provide these refunds. But I don't want to kind of get into my predictions, things that I'm watching just yet, but it is very much related, kind of this concept around tariffs, a bit of this renewed clarity, and what I'm thinking about in terms of import volumes.
Sure, absolutely, that makes sense. Well, why don't we get into it? I think we made a total of 10 predictions in that episode, which anyone's welcome to go in and review and check us, but we copied them here. So these are literally what was said in December of last year. One of the predictions was global trade is now civilization mode, for anyone familiar with the board game. Kyle, do you want to comment a little bit on what was intended when we made that statement and what we've seen so far in the first half of this year?
Yeah, I mean, since the late 90s, where the U.S. was the top dog following the Cold War, we kind of had the hegemon carte blanche over how the world trade was going to play out. Well, time has passed and those times have changed, and now we have a multipolar world at the end of the day. And that is going to change the mindset of all the different players, which were probably already changed, but they just weren't talking about it as vehemently as they once were, because the kind of leverage the U.S. has over other powers is not as strong as it once was. Other countries, other regions have caught up in terms of the power projection game. And I've also caught on to how they can leverage the dependencies that they may have highly local control over as well. So it's civilization mode because it's Europe in the 1700s and 1800s yet again, where there's lots of similarly power-sized players vying for advantage.
Yeah. Yeah, and obviously when we made this prediction in December of last year, none of us could have foreseen what would happen in the Strait of Hormuz with Iran. That was clearly an example where the U.S. wasn't going to wait, right? We basically made the decision to go in, to take the initiative, to shake things up, to try to get a better deal. And I think a perfect example of the way this civilization mode type prediction would play out is that you're going to have different players sort of taking the proactive approach of gaining leverage, whether it's in a geopolitical zone or it's in an industry like energy with what's happening with Russia and the sanctions on countries that were buying energy products from Russia, and how all of that's now disrupted with what's happened in the Middle East. And you have some other industries called out here as well, right? Metals. Kyle, is that right? We saw a change in aluminum sourcing for that. Yeah.
Metals, energy, ag. There's been changes all around, but especially with that comment around smaller powers, but having hyper local leverage with the Strait of Hormuz and so much of metal refinement, specifically around aluminum sourcing, aluminum coming out of the Persian Gulf. That was a massive hit to the global supply. And aluminum, even though it is the most prevalent metal on the planet, it is also one of the most used metals in all manufacturing, production, et cetera. And so restructuring that overnight isn't done easily.
I think also the one knock-on effect, particularly around energy, is energy such a large input into the processing category you have here on the right. And to your point around aluminum, we can go extract aluminum, but it has a meaningful processing value stream that has a lot of petroleum byproducts as part of it.
Mm-hmm.
And when we think about the AI boom we're in, everybody might default to energy. But if you actually even look at how chips are practically manufactured, there are a lot of petroleum byproducts that are inputs into that. Yep. And so that value chain has yet to show any weakness. Hopefully it doesn't, because that's only going to exacerbate kind of questions around the longevity and runway we have related to the current AI cycle. But you are seeing a lot of Asian economies, right, coming under stress because they do not have the historical access to energy that they were used to and created their economies around. Like China's made mention of it, Vietnam, India, and what's ultimately going to happen is they might need to go start trading more with Russia, who has an easier vantage point to provide them with those energy supplies. Last thing I'll also say that I thought was interesting a few weeks ago, an article emerged that because the Strait of Hormuz has effectively been in a logjam, a lot of these Gulf nations are saying, hey, we'll actually find alternative means of transport to get our exports out of the region. Pipeline, rail, and even truck. I know that kind of the Saudis are trying all three of these things as a way to ensure that their economies thrive, but it doesn't create kind of a bunch of these headaches globally.
Absolutely. And on that vein of kind of reshuffling, I think the next slide here, Kyle, dives in particular into the topic around aluminum. So, my takeaway really from this slide is volume overall in terms of U.S. imports of aluminum has not actually changed. And yet we are down 68% year on year with the amount we typically import from the UAE. And yes, that's despite, many of these Arab nations and their efforts to create land bridges or ship via alternate routes. But with a commodity like aluminum, we're finding alternative origins, ways of getting the product into the U.S. So I think so far we're 2 for 2, Santosh. The civilization is kind of the new mode of operating for many of these countries with global trade, and then the call out here that non-commodity flows are really the red herring, not something to pay attention to, but specifically commodity-centric trade flows are we're gonna see a lot of changing in 2026. So far, I'd say your predictions were very accurate.
I'll take it where I can get it.
Yeah.
But nearshoring, some interesting comments about nearshoring made roughly 6 months ago. And it's certainly true, and it's certainly been playing out around, say, the North American space and Southeast Asia space as well. What's partly interesting about the Mexico to U.S. shift, so like the peak year over year with a very little volatility range, but it's certainly been seeing that some of the first tactics in trying to get near shore protection or say rerouting protection around tariffs and such was send it to Mexico first, repackage, finish manufacturing there, and then truck it over, train it over, potentially the route maybe over ocean as well into the U.S. But the China plus one reallocation has been very strong. I mean, Vietnam, it has surpassed China in terms of imports into the United States for apparel for the first time ever in the past 6 months. And so Vietnam has benefited, Indonesia has benefited, Philippines, India, Bangladesh, they've all benefited in some way from this +1 China strategies being played out. But I think what's interesting about the past few months is even those +1 strategies have been stressed from a geography perspective. Going back to the energy topic, in more peaceful times, everyone had built their infrastructure without the mindset of, I need to keep, potentially months, if not years, of bunkered fuel in country type of situation. So like vast majorities of commercial flights are being canceled. You were having reduced voyages, plus also just the dumping of cargo all across the region as the Strait closed and the vessels were scattered effectively, and reallocation of the vessel capacity out to different lanes. So it's interesting that the strategy was a China +1 in some sense, but it might need to be a region ×3 type of strategy for the future instead. So more mitigation with more geographic disbursement as we look forward. But then Santosh, I'm sure you guys have comments here.
No, I think this is another evidence of 3 for 3, and that was clearly really already the case at the end of 2025. So we're seeing more of the same, right? If anything, those trends are accelerating and not slowing down, and that tariffs may have been kind of the fuel to the fire. But now the reallocation, the growth in imports from Vietnam, Thailand, Malaysia, and the like, I don't think they're going away anytime soon.
So I'm going to kind of jump in and I guess kind of share one of the things that I wouldn't quite call it a prediction, maybe so. You all can pass judgment. But going to the point around Vietnam, I think in January, Vietnam officially became our largest trading partner with a surplus because of this transshipment dynamic that supply chains had adopted. And the one thing that we do need to bear in mind of is these new tariffs that have been proposed, specifically kind of trying to target forced labor. It's really a means to kind of snuff this type of activity out, right? Because when you create regulation here, there's usually a loophole, and then people are going to leverage that loophole. And the question is whether this has continued longevity. Is this, transshipment as a strategy, so to speak, over, and we're not going to see it again? And at that point, it's really about like true manufacturing reallocation winning. We don't know yet, but it is something I'm spending kind of a bit of time, energy trying to figure out, hey, are there data points we can pick up on that would be useful? But again, we all know like one doesn't just pick up manufacturing and move it. But I think most supply chain officers, procurement officers that I've spoken to since COVID, there's always a parallel path and there's multiple kind of irons in the fire in order to deal with this stuff. So it might be that we really see this come to a head when people say, hey, we can no longer use the Vietnam strategy. That was our preferred easiest path. We're going to have to go to plan B or C at this point.
Agreed. Absolutely. Well, of the predictions that have been, clearly accurate so far, not all of them were so. So Santosh, you don't have quite a perfect record, at least so far, for the first 6 months. We have another 2 quarters, but one thing that we talked about were the upcoming earnings releases and ocean carriers kind of able to weather the storm with tariffs and whatever else might come up in 2026. And we, all 3 of us really agreed that they would find ways to protect their profitability. Well, those creative solutions that carriers, had at their disposal, it seems like basically ran out. And my assumption here is really the Iran conflict, the Strait of Hormuz, the pressure on bunker fuel prices, all of that really was a perfect storm. Insurance premiums going up, where the carriers could only do so much to reroute or to charge these sort of premiums. But obviously you see 3 of the major ones that do publicly release their earnings, so far are down year on year.
It'll be very interesting to see what Q2 says as they start to come out over the next 30, 60, 90 days.
Yeah,
I agree. And perhaps because this is only one quarter, it's too early to say, but insurance premiums, kind of really it's the war premium, right? That is really a factor, and then increased energy costs. Those weren't things that they really thought about and had included, given we didn't expect the conflict in the Middle East. I am a bit surprised that there has not been a more proactive posture around managing rates up through things like blank sailings, rolling freight, in an effort to at least, avoid these losses on the right-hand side that happened during the quarter.
We have seen some of that start to kick up a bit in May, where previously you could pay a premium to guarantee your slot on the vessel, because some cargo was getting rolled forward onto an earlier vessel. But if you know what vessel you want, you could start paying a premium, and that's kind of been baked in now. If you actually want that vessel, there's no negotiating around that premium. It's just a fee at this point. And we also saw that most of the blanks were happening across Trans-Pacific because there was kind of just a reallocation of vessels to the more in-demand routes, since there was demand going Trans-Pacific, but it wasn't as pressing. And partly maybe why we were also seeing a little bit of that pull forward with the earlier peak season, right? Because some capacity was coming off that. And with all of the uncertainty, buyers in the States were just saying, get it here sooner. I'd rather pay the warehousing versus not have it at all type of scenario.
The one thing kind of second half that I'm going to go out and stick my neck out is I don't think we're going to be seeing a state where we can kind of in a very binary fashion say the Strait of Hormuz is open.
Yeah. Going back to what it once was, regardless.
No. And I think kind of we had an example of that in the last week or two, where Washington said, hey, we're going to sign an agreement on Friday. Turns out they negotiated through the weekend. Right. Now, Iran at that point showed up and said, hey, no, like things are actually going well. But then there was renewed conflict in Lebanon that soured everything. Exactly. And so I think we're going to kind of be in this really strange world where, depending on the week, you might feel comfortable that you could sail through the Strait. Otherwise, you're going to continue to kind of route around the Cape. Yeah. And the impact that has on rates is to be determined. But I wonder, even though there is going to be extra capacity out on the open oceans, whether that is ultimately actually going to result in a rate increase. Ultimately, because you're going to have this latent capacity on standby, because week to week, no one really knows what's going to happen in the Middle East.
Now, would you apply that same thinking to the Red Sea, right, where some carriers have begun to return to sail there? That has a big impact on the Asia to Europe trade, on the Asia to U.S. East Coast trade, where now the Panama Canal doesn't benefit from the Red Sea and the Suez Canal effectively being closed. Do you see that opening continuing in the second half?
I would approach a similar position around the Red Sea as well. And it's because these conflicts are also interlinked, right? And there's a general lack of predictability around what type of emotion, strategy, perspective is being drawn on that given week. And so there's going to have to almost be this redundancy, which is kind of a very strange thing to say. And I don't know whether there has been this concept of redundancy ever in the history of modern maritime shipping, but it appears to have to be necessary. Because what's the alternative then? You're either going to continue to burn down inventories in your end market. You're going to have stock outs if you think about retail goods, so lost revenue, or you're going to airship it, and there's very few things that justify the cost of air shipment.
Right.
Santosh, do you think while there's still some expectation of ocean freight volumes growing relatively year over year, somewhat in lockstep with population growth, do you think that should be tapered slightly? Because this transition won't be to China plus one. The transition will be to regions times three type of thing. And some of that manufacturing will be happening far closer to home than it once was, where rail and truck or short sea transit for so potential for different carriers to be popping up now that didn't exist before, even especially as we start talking about like the Jones Act and where that's all going to be going. What does the future hold for U.S. based maritime companies as well? I have just far less certainty about the direction all that will be going, but it doesn't look like it's going to continue the same way.
I agree, and if we were to take, let's say, kind of towards the end of the decade perspective, I think you're going to start to see it go from, it was about 5% last year, if I remember correctly, 4 to 5% annual growth in kind of ocean cargo volumes. I think you'll approach something akin to global GDP growth. Okay. And the balance will likely be perhaps maybe in Europe, who has had a better competency around like inland waterway transport. You'll see that pick up a little bit of the slack in addition to rail. But I think in the US, you're going to see trucking and rail really capture that. And you're seeing LTL and also rail volumes start to kind of reflect that, especially LTL around manufacturing. So Jones Act, who's to really say? There's definitely going to be some benefit from it, but there's so few carriers who truly kind of have that rigor operating under the Jones Act. I think like Crowley is effectively your leader, and if Crowley already has that first mover advantage, and I guess Matson as well, do they basically lap up all of that opportunity because they also have multimodal capability alongside? So that could be actually the elegant solution here for a provider.
Yeah, because like a smaller carrier like Young Brothers, which predominantly serves Hawaii and like the U.S. West Coast, but also the more Caribbean regional carriers, will be interesting to see how that plays out. As you know, you might be having manufacturing getting set up in a more meaningful way in Central America to then be serving the U.S. Gulf Coast or East Coast. But we'll see. Just wait. If you don't know, wait.
So I think on that topic, with a minute left here, I want to go to the slide after this, Kyle, around the trade deficit. So I think this is similar to what we were just talking about, protecting U.S. economic interests, essentially, and the stated goal of the tariffs and all the foreign policy moves last year was we want to lessen this trade deficit. We want better terms and leverage in our trade relationships with these other countries. And our prediction at the end of last year was that that wasn't going to work. We were going to say that we were going to see the trade deficit potentially widen, or at least not improve and stay flat. The data's early in this. Obviously, we're seeing bookings for the first 6 months of the year impacted by a lot of what's going on in the Middle East, and we might return to a little bit more of a normal state with what's happened in the last 4 weeks in terms of early peak season. But the conclusion here is too early to tell if the trade deficit is getting worse or better.
I think so. Granted, the judgment around the tariffs also might suggest that at best it might stay flat. Right. So too early to tell. There does appear to be a bit of like the tariff induced pull forward that we're seeing. And I think we might see that probably towards the end of next month, early August, and then it'll probably start to subside, given kind of additional clarity around tariff judgment. So TBD.
Yeah, I could see a scenario where we're just getting our breath in a sense, whether it's importers or exporters, right? Looking to, a part of our policies with the European Union was to ramp up our automotive exports to the EU, right? That's impacted by the shakeup into the aluminum supply chain based on the Middle East. And so everyone's just kind of collecting themselves, gathering their breath, hopefully to return to a normal second half of the year. But just the slightest disruption, right? You could imagine something like the Russia-Ukraine conflict ramping up, the Panama Canal being prepared for another El Nino season. Who knows what's going to happen with Taiwan and our relations with China around there. So these are all possibilities that I think could have a direct impact on the trade deficit. Obviously, many other things, but that prediction in particular, I think, is sensitive to what disruptions could happen in the next 2 quarters.
All right. Well, we've hit time. So thank you to our audience. Thank you to Santosh. We'll
Happy
share
to be
the
here.
slides publicly, of course. There were a few topics we didn't hit, but we're happy to have chats online about that. So feel free to be commenting on the deck as it's sent out on LinkedIn or on our website. And as always, thank you for watching. This is us signing off.
We'll see you in 2 weeks.
Cheers.
2 weeks.
Bye-bye.
TradeView Live next episode. Ciao, ciao.